Imagine unlocking a hidden map that reveals the veins of global power, where debt flows like blood-sustaining empires. By the end of this video, you'll grasp how these financial arteries can lead you to personal wealth, arming you with insights to navigate economic storms and emerge richer in knowledge and opportunity. The United States debt stands as a colossal force in the world economy. Foreign nations hold trillions in U.S. Treasury securities, essentially lending money to America. This arrangement binds countries in a web of mutual dependence, where stability hinges on trust in the dollar's strength. As of November 2025, total foreign holdings reached $93.4 billion. This marks a record high, reflecting growing confidence or strategic positioning amid global uncertainties. Yet, this vast sum represents both opportunity and vulnerability for all involved. Japan leads the pack with $1,202.6 billion in holdings. This amount has increased by $115.5 billion from November 2024, showing a consistent buildup over 11 straight months. Such accumulation underscores Japan's role as a steadfast ally in financing America's fiscal needs. The United Kingdom follows closely, holding $888.5 billion. Their stake rose by $121.6 billion year over year, often serving as a conduit for hedge fund activities. This positions the UK as a key player in the shadowy world of international finance. China, once a dominant force, now holds $682.6 billion. This figure has dropped by $86 billion from the previous year, hitting the lowest level since September 2008. The decline signals shifting priorities amid trade tensions and domestic economic pressures. Belgium surges ahead with $481 billion, up $119.7 billion annually. This growth highlights Europe's complex involvement in U.S. debt markets. Belgium acts as a hub for custodial holdings, masking the true origins of investments. Canada's holdings stand at $472.2 billion, marking a $99.8 billion increase. This record level reverses earlier dips tied to trade disputes. It illustrates how neighboring ties influence financial decisions in turbulent times. The Cayman Islands hold $427.4 billion, with a modest $22.1 billion rise. Known for tax advantages, this territory channels funds from global elites. It reveals the opaque layers in debt ownership. Luxembourg possesses $425.6 billion, up $7.8 billion. As another financial center, it facilitates European and international investments. This steady hold emphasizes the role of small nations in big games. France owns $376.1 billion, increasing by $43.6 billion. This reflects renewed interest amid economic recoveries. France's position adds a layer of transatlantic balance. Ireland holds $340.3 billion, down slightly by $2.8 billion. Despite the dip, it remains a significant player through corporate channels. This stability masks underlying shifts in investment strategies. Taiwan has $312.5 billion, up $26.5 billion. Amid geopolitical tensions, this holding serves as a hedge against uncertainties. It demonstrates how debt intertwines with security concerns. Switzerland maintains $300.3 billion, with a minor $1.6 billion gain. Renowned for neutrality, its involvement adds credibility to the system. This consistent presence bolsters global confidence. Singapore's stake is $272.2 billion, rising by $20 billion. As an Asian financial powerhouse, it diversifies its reserves strategically. This move highlights emerging market dynamics. Hong Kong holds $256 billion, down $9.8 billion. Influenced by regional politics, this reduction signals caution. Yet, it remains a vital link in the chain. Norway owns $218.9 billion, up $56.4 billion. Oil wealth fuels this investment, seeking safe harbors. It exemplifies resource-rich nations' approaches. India has $186.5 billion, decreasing by $47.5 billion. This pullback amid domestic priorities reflects recalibration. Still, it shows growing economies' engagement. Brazil holds $168.1 billion, down $60.9 billion. Economic challenges prompt this reduction. It underscores volatility in developing markets. Saudi Arabia possesses $148.8 billion, up $13.2 billion. Tied to oil and alliances, this increase strengthens ties. It reveals energy geopolitics at play. South Korea owns $145.1 billion, rising by $17.6 billion. Technological synergies drive this growth. It highlights innovation-driven investments. Germany holds $109.8 billion, up $9.7 billion. As Europe's engine, its stake adds weight. This measured approach mirrors fiscal prudence. Israel has $107.7 billion, increasing by $20.2 billion. Strategic alliances fuel this rise. It demonstrates debt's role in diplomacy. All other countries collectively hold $1,833.1 billion, up $143.8 billion. This diverse group amplifies the global reach. It shows the breadth of international involvement. These holdings are not mere numbers. They represent calculated power plays. Nations buy U.S. debt to park reserves safely, influence policy, or hedge risks. In return, America funds its deficits, sustaining growth, but at a cost. The annual changes reveal underlying currents. Some nations add debt, signaling optimism or necessity. Others reduce, perhaps diversifying or responding to domestic needs. Japan's 11% increase to $1,202.6 billion exemplifies commitment. Amid low domestic yields, it seeks better returns abroad. This strategy maintains balance in its vast reserves. China's 11% decline to $682.6 billion speaks volumes. Once peaking over $1 trillion, this drawdown aligns with de-risking efforts. It shifts focus to internal development and alternative assets. The UK's 16% growth to $888.5 billion indicates inflows. As a custody hub, it channels hedge fund bets on U.S. recovery. This amplifies market sentiments. Belgium's 33% surge to $481 billion stands out. It positions as a European gateway for investments. This rapid rise reflects shifting capital flows. Canada's 27% increase to $472.2 billion reverses prior trends. Post-tariff resolutions, it rebuilds positions. This rebound underscores resilient bilateral relations. Interest payments add another dimension. In Q3 2025, the U.S. paid a record $287 billion to foreign holders. This outflow drains national resources, funding overseas economies. Such payments totaled hundreds of billions annually. They represent the price of borrowing dominance. As rates rise, this burden intensifies, squeezing budgets. Geopolitically, debt holdings wield influence. China could sell to pressure policy, though self-harm deters it. Japan holds steady, aligning with alliances. Europe's fragmented holdings dilute power. Yet, collective action could sway markets. This interdependence fosters stability, but breeds fragility. For individuals, this matters profoundly. National debt affects currency strength, impacting savings and investments. Understanding holders helps predict economic shifts. In a world of rising rates, debt sustainability questions arise. Foreign pullbacks could spike yields, slowing growth. Vigilance becomes key to personal finance. Yet, opportunities emerge in chaos. Diversify like nations do, balancing assets globally. Knowledge of these dynamics empowers smarter decisions. Consider trends among youth, crypto as alternative to traditional debt. While nations hoard treasuries, digital assets offer decentralization. Blending both could hedge against fiat vulnerabilities. The US dollar's reserve status underpins this system. Foreign demand keeps rates low, fueling consumption. But challengers like BRICS currencies loom. Historical parallels abound. Empires fell under debt weight, from Rome to Britain. America navigates similarly, with foreign lenders as silent overlords. Strategic reductions, like China's, signal multipolarity. As holdings diversify, power diffuses. This reshapes global order subtly. Interest burdens compound the issue. With $287 billion in one quarter, annual figures soar. This diverts funds from innovation to repayment. Fiscal policy must adapt. Cutting deficits reduces reliance on foreigners. Yet, political gridlock perpetuates the cycle. For viewers, this insight unlocks paths to prosperity. Monitor holdings for market cues, adjusting portfolios accordingly. Wealth builds on foresight, not chance. In conclusion, the web of U.S. debt holders weaves a tapestry of control and vulnerability. Grasp its threads, and you command your economic destiny. Reflect on this. In the game of nations, knowledge is the ultimate currency. Shifting our gaze to the horizon, imagine a world where debt becomes a weapon in silent wars. By watching this unfold, you'll uncover strategies to shield your finances from global tremors, turning economic insight into a fortress of personal prosperity. This knowledge isn't just power, it's your edge in an unpredictable arena. Beneath the surface, U.S. debt holdings mask intricate alliances. Foreign investors buy treasuries for safety, yielding returns while anchoring their currencies to the dollar. Yet, this symbiosis carries risks, as sudden sell-offs could trigger market chaos. Historically, empires have crumbled under similar burdens. Rome borrowed heavily, leading to inflation and decline. Britain post-World War II ceded global dominance amid debt repayments, a cautionary echo for America today. In modern terms, China's reduction from over $1 trillion to $682.6 billion hints at decoupling. This strategic retreat diversifies reserves into gold and euros, challenging dollar hegemony. It forces the U.S. to court other lenders, reshaping power dynamics. Japan's steadfast increase to $1,202.6 billion stems from demographic pressures. With an aging population, it parks pension funds in stable assets. This mutual reliance fortifies U.S.-Japan ties against regional threats. Europe's collective stake, from the UK's $888.5 billion to Belgium's $481 billion, fragments influence. No single nation dominates, diluting leverage. Still, unified action could pressure U.S. policy on trade or climate. Offshore havens like the Cayman Islands at $427.4 billion obscure true owners. Hedge funds and corporations funnel capital here for anonymity. This opacity breeds suspicion, fueling debates on financial transparency. Emerging markets show volatility, with India's drop to $186.5 billion amid growth needs. Brazil's decline to $168.1 billion reflects currency woes. These shifts highlight how domestic crises ripple into global finance. Interest payments exacerbate the strain, with $287 billion in Q3 2025 alone. Projected annually, this nears $1 trillion, siphoning funds from infrastructure. It underscores the hidden cost of fiscal profligacy. For the youth tuning in, consider crypto as a counter-narrative. While nations hoard treasuries, Bitcoin and Ethereum offer borderless alternatives. Blending traditional debt insights with digital assets could build resilient portfolios. Trends like meme stocks and NFTs reveal generational shifts. Young investors seek high-risk, high-reward plays over safe bonds. Understanding U.S. debt holders equips you to spot when these worlds collide. Geopolitical flashpoints amplify risks. Taiwan's $312.5 billion, holding ties economics to security. Any conflict could prompt dumps, spiking U.S. borrowing costs overnight. Saudi Arabia's $148.8 billion links oil to debt. As energy transitions accelerate, this bond may fray. It illustrates how commodities underpin financial empires. South Korea's rise to $145.1 billion mirrors tech synergies. Joint ventures in chips and EVs drive mutual investments. This fusion of innovation and finance propels growth. Germany's prudent $109.8 billion reflects fiscal discipline. Unlike spendthrift peers, it balances holdings with exports. This model offers lessons in sustainable economics. Israel's $107.7 billion underscores strategic depth. Aid and alliances intertwine with debt. It demonstrates how military pacts extend into treasuries. The other countries category, at $1833.1 billion, encompasses diverse players. From small islands to African nations, it broadens the base. This diffusion stabilizes the system against concentrated shocks. Future outlooks hinge on inflation and rates. If the Fed hikes further, foreign demand may wane. This could force domestic buyers to step up, altering the landscape. Policy responses matter profoundly. Tariffs or sanctions might alienate holders like China. Diplomatic finesse preserves inflows, maintaining low-cost borrowing. Personal takeaways abound in this maze. Track Treasury auctions for signals on holder sentiment. Adjust investments accordingly, favoring assets that thrive in uncertainty. Empowerment lies in awareness. Nations maneuver with trillions, but individuals can mirror their caution. Build wealth by anticipating these global chess moves. As we peer deeper, the debt web reveals not just obligation, but opportunity. Master its patterns, and you navigate toward abundance. Ponder this. In the shadows of finance, foresight forges fortunes. As shadows lengthen over the global stage, envision debt as a double-edged sword forged in secrecy. Finish this journey, and you'll wield tactics to outmaneuver financial pitfalls, crafting a legacy of abundance from the ruins of economic empires. This wisdom transforms mere survival into calculated conquest. Delving into the mechanics, U.S. Treasuries offer unparalleled liquidity. Foreign holders can buy or sell vast amounts without market disruption. This fluidity cements the dollar's throne, yet exposes it to whims of distant capitals. Consider the role of central banks in this ballet. Japan's Bank of Japan amasses holdings to manage yen strength. China's People's Bank pares back to bolster renminbi ambitions, a slow erosion of American primacy. Europe's mosaic, with Luxembourg at $425.6 billion and France at $376.1 billion, channels institutional funds. These nations act as proxies for pensions and insurers. Their increments signal bets on U.S. resilience amid Eurozone woes. Ireland's $340.3 billion, despite a dip, ties to tech giants' tax strategies. Multinationals park profits here, funneling into treasuries. This corporate interplay blurs lines between state and enterprise. Switzerland's $300.3 billion embodies discretion. Banks safeguard wealth for the elite, favoring stability over yield. It whispers of hidden fortunes shaping visible policies. Singapore's $272.2 billion ascent reflects sovereign wealth prowess. Temasek and GIC diversify oil windfalls into safe assets. This prudence models how city-states punch above weight. Hong Kong's retreat to $256 billion mirrors Beijing's grip. As autonomy wanes, holdings adjust to mainland directives. It foreshadows how politics eclipses economics. Norway's $218.9 billion surge draws from its oil fund. The world's largest sovereign wealth entity seeks ethical, stable returns. This approach contrasts with riskier peers, prioritizing longevity. The collective other, at $1833.1 billion, hides emerging powers. Nations like Turkey or Mexico nibble at edges, testing waters. Their growth could fragment dominance further. Economic theories underpin this edifice. Modern monetary theory suggests deficits matter little with reserve currency. Yet, foreign saturation tests limits, risking inflation spirals. Critics warn of debt traps, akin to Third World woes. America borrows in its currency, averting default. But dependency breeds subtle coercion from holders. Youth trends pivot to decentralization, with DAOs challenging central banks. As treasuries centralize power, blockchain disperses it. Merging insights from both realms fortifies personal empires. Flashpoints like US-China tech wars accelerate shifts. Taiwan's $312.5 billion becomes a bargaining chip. Escalation could cascade into sell-offs, unraveling markets. Energy transitions threaten Saudi Arabia's $148.8 billion stake. As renewables rise, petrodollars seek new homes. This pivot redefines alliances in a greening world. South Korea's $145.1 billion ties to supply chains. Semiconductors fuel mutual dependence. Disruptions here ripple through global tech, amplifying debt's reach. Germany's $109.8 billion mirrors export-driven caution. Surpluses fund holdings, hedging against euro instability. It exemplifies balanced books in an imbalanced world. Israel's $107.7 billion intertwines with innovation aid. Tech transfers bolster economic bonds. This synergy extends beyond borders, fusing defense with dollars. Projections paint a precarious path. If holdings peak, yields climb, stifling growth. Diversification into alternatives like gold accelerates, diluting dollar demand. Policy levers include debt ceilings and spending cuts. Yet, partisanship paralyzes action. Foreign observers watch, adjusting positions in anticipation. For you, this translates to vigilance in investments. Shadow national strategies. Diversify beyond dollars. Wealth accrues to those who read the runes of global finance. In this labyrinth of ledgers, opportunity lurks in every line. Command these currents, and prosperity follows inexorably. Contemplate. Empires rise on borrowed time, but the astute inherit the hourglass. As the veil lifts further, behold debt not as burden, but as the silent architect of empires. Absorb this final layer, and you'll forge an unbreakable shield for your wealth, turning global vulnerabilities into your personal vault of opportunity. Mastery here elevates you above the fray, where others falter and you prevail. Peering into the abyss, the total foreign stake hovers at $9.4 trillion as of November 2025. This pinnacle reflects a delicate equilibrium, where lenders sustain America's might in exchange for perceived invincibility. Yet, cracks emerge when trust wavers, threatening cascades no nation can fully control. Japan's dominance at $1.2 trillion, up 11%, anchors the system. Its relentless buying counters domestic stagnation, recycling trade surpluses into U.S. securities. This loop fortifies alliances, but binds Tokyo to Washington's fiscal fate. The United Kingdom's $888.9 billion, swelled by 16%, conceals deeper maneuvers. London serves as a gateway for speculative capital, amplifying bets on American recovery. It illustrates how financial hubs wield influence without direct ownership. China's retreat to $682.6 billion, down 11%, accelerates a profound realignment. Shedding holdings frees capital for Belt and Road ambitions and yuan internationalization. This calculated withdrawal chips away at unipolar dominance, heralding a multipolar dawn. Belgium's explosive 33% rise to $481 billion exposes custodial veils. Euroclear channels anonymous funds, often from Middle Eastern sovereigns or Asian tycoons. Such surrogates obscure true power, complicating any reckoning. Canada's 27% leap to $472.2 billion mends prior fractures. Proximity demands alignment as trade flows intertwine with debt. It reminds us that geography dictates financial loyalty in uncertain times. Offshore enigmas persist, with the Cayman Islands at $427.4 billion and Luxembourg at $425.6 billion. These havens shelter fortunes from scrutiny, funneling elite wealth into the safest harbor. Their presence underscores inequality's role in sustaining the edifice. France's $376.1 billion, up 13%, revives European commitment. Amid internal strife, it seeks stability across the Atlantic. This resurgence balances transatlantic tensions with pragmatic investment. Ireland's resilient $340.3 billion navigates corporate tax labyrinths. Tech behemoths domicile profits here, indirectly bolstering U.S. debt. It fuses innovation economies with traditional finance in unexpected ways. Taiwan's $312.5 billion, up 9%, doubles as strategic armor. Holdings hedge against aggression, intertwining economics with existential defense. Any disruption here could ignite broader conflagrations. Switzerland's steady $300.8 billion epitomizes calculated neutrality. Private banks guard assets through turmoil, favoring treasuries for unwavering reliability. It lends the system an aura of untouchable permanence. Singapore's $272.2 billion ascent showcases disciplined sovereignty. Wealth funds deploy surpluses methodically, blending safety with subtle influence. This model inspires smaller players to amplify their voice. The interest toll mounts inexorably, with $287 billion paid in Q3 2025 alone. Extrapolated, annual outflows approach staggering heights, redirecting American productivity abroad. This quiet hemorrhage constrains domestic potential, prioritizing creditors over citizens. For the ambitious young, this landscape contrasts sharply with digital frontiers. While nations cling to bonds yielding modest returns, crypto ecosystems promise sovereignty without intermediaries. Bitcoin mirrors gold's scarcity, evading the debt cycles that ensnare fiat realms. Meme-driven rallies and DeFi protocols capture youthful defiance against centralized control. Yet, integrating debt awareness tempers speculation, blending high-volatility plays with grounded hedges. True wealth emerges from this synthesis, not blind rebellion. Geopolitical undercurrents intensify scrutiny. Saudi Arabia's $148.8 billion ties petrodollars to security pacts. As green energy disrupts oil hegemony petrodollars, realignments loom, potentially redirecting flows elsewhere. South Korea's $145.1 billion growth aligns with technological ascendancy. Shared threats foster deeper integration, where chips and treasuries reinforce mutual strength. It exemplifies how innovation sectors transcend traditional boundaries. Smaller stakes carry outsized symbolism. Israel's $107.7 billion, up 23%, cements unbreakable bonds. Germany's measured $109.8 billion reflects disciplined restraint amid continental chaos. The vast other countries bloc at $1.8 trillion disperses risk widely. Emerging voices from Africa to Latin America participate tentatively, broadening participation while diluting any single threat. Scenarios of rupture haunt the margins. Coordinated reductions could elevate yields, curtailing U.S. spending power. Yet, self-interest deters aggression, as dumping erodes holders' own wealth. Conversely, sustained demand perpetuates the exorbitant privilege. America borrows cheaply in its currency, exporting inflation while importing goods. This asymmetry fuels prosperity, but invites resentment over time. Policy imperatives demand reckoning. Deficit reduction lightens foreign dependence, reclaiming autonomy. Fiscal prudence, though politically elusive, preserves long-term sovereignty. For you, this distills into actionable dominion. Mirror Japan's diversification, allocating across assets immune to single-nation risks. Monitor holder shifts as harbingers, repositioning before crowds react. In volatile markets, knowledge compounds like interest. Anticipate China's pivot by exploring renminbi assets or commodities. Emulate Belgium's opacity with privacy-focused instruments. Ultimately, the debt mosaic reveals a profound truth. Power flows not from armies alone, but from ledgers that command obedience. Wield this understanding, and you transcend spectator status, becoming architect of your affluence. As curtains draw on this revelation, carry forth the insight. In the grand theater of finance, the informed puppeteer inherits control. Fortunes favor those who decipher the chains others wear as crowns. As the grand design crystallizes, recognize debt as the invisible throne upon which superpowers sit uneasily. Embrace this culmination, and you'll emerge equipped with ironclad strategies to multiply wealth, exploiting the fractures in global finance while others remain chained to ignorance. This final mastery grants you dominion over your financial realm, where empires bow to the prepared mind. Reflect on the pinnacle reached in November 2025, with foreign holdings cresting at $9.4 trillion. This summit embodies a precarious pinnacle, sustained by calculated faith in America's borrowing machine. Yet, beneath the calm tectonic shifts brew, ready to redefine wealth's geography. Japan's unyielding grip on $1.2 trillion, bolstered by an 11% rise, reveals a profound interdependence. It recycles surpluses into treasuries, shielding its economy while propping up U.S. deficits. This alliance, forged in post-war ashes, now chains both to mutual survival. China's deliberate contraction to $683 billion, slashed by 11%, marks the boldest maneuver. Peeling away from peak holdings over $1 trillion, it redirects resources toward self-reliance and alternative blocks. This exodus erodes the dollar's unchallenged reign, subtly tilting the board toward equilibrium. Europe's scattered forces, led by Belgium's $481 billion, up 33%, and the UK's $889 billion, up 16%, project fragmented might. Custodial hubs mask deeper investors, allowing influence without accountability. Their surges signal refuge-seeking amid continental storms. North America's solidarity shines through Canada's $472 billion, surged 27%. Proximity breeds alignment, as economic veins pulse in unison. This rebound heals old wounds, fortifying borders with bonds. Offshore shadows loom large, with the Cayman Islands at $427 billion and Luxembourg at $426 billion. These enclaves harbor anonymous capital, evading light while anchoring the system. Their steady presence exposes the elite's quiet orchestration. Asian strongholds diversify the landscape. Taiwan's $313 billion, up 9%, serves as both investment and insurance. Singapore's $272 billion, risen 8%, exemplifies precision in reserve management. Resource giants assert themselves differently. Norway's $219 billion leaped 35%, channels oil bounty into enduring safety. Saudi Arabia's $149 billion, up 10%, binds energy flows to financial loyalty. Emerging voices echo caution. India's retreat to $187 billion, down 20%, prioritizes internal fires. Brazil's fall to $168 billion, plunged 27%, mirrors turbulent home fronts. The relentless interest drain, peaking at $287 billion in Q3 2025, extracts a heavy toll. This quarterly hemorrhage, when annualized, diverts vast sums overseas, starving domestic renewal. It lays bare the insidious price of perpetual borrowing. For the rising generation, this archaic web clashes with digital liberation. Nations accumulate low-yield bonds, yet crypto vaults promise uncensored sovereignty. Ethereum's smart contracts and Bitcoin's immutability defy the debt-laden fiat order. DeFi yields outpace Treasury returns, attracting those weary of centralized strings. Meme coins surge on collective fervor, mirroring youthful rejection of inherited chains. Fuse this rebellion with debt's cold lessons, and portfolios become anti-fragile fortresses. Geostrategic fault lines heighten the stakes. South Korea's $145 billion ties tech frontiers to fiscal support. Israel's $108 billion, up 23%, weaves security pacts into economic threads. The sprawling other category at $1.8 trillion disperses power broadly. Countless nations contribute, preventing any single rupture from toppling the structure. This diffusion buys time, but masks brewing dissatisfactions. Envision pathways forward. Sustained foreign appetite keeps U.S. rates suppressed, fueling asset bubbles. Withdrawal waves would ignite inflation, punishing the unprepared while rewarding the vigilant. Personal sovereignty demands emulation of the shrewd. Diversify as China does, allocating to gold, commodities, and emerging currencies. Hedge like Taiwan, balancing geopolitically charged assets. Track monthly TIC reports as oracles of sentiment. Shifts in holdings precede market tremors, offering windows to reposition. Wealth flows to those who anticipate, not react. In this eternal ledger of power, the astute transcend servitude. Nations borrow tomorrow's strength today, but individuals can compound foresight into legacy. Command these truths, and abundance becomes inevitable. As the narrative closes, internalize the essence. Debt binds the mighty, yet knowledge unshackles the wise. In finance's unforgiving arena, the enlightened do not merely endure, they conquer. Your empire awaits construction.